Yeah, that's actually how I start my show. All the time. So I'm glad you're
I
here.
had to do it.
Yeah, got to finally bring in the entertainment.
Yeah.
Welcome.
Good to be here.
That's great. Luis de la Cruz, mortgage broker extraordinaire. I've been, obviously, besides using your services for my customers over the years, also good buddy of mine, and looking forward to having this conversation. I think it's really timely because there's been so much change going on right now in the market, and I obviously would love to have your take on it besides what a real estate professional that is dealing with customers all day, every day, in the trenches, trying to find something that's affordable, attractive, meets their needs, all these different things, especially in the what I call that meaty middle price point, can sometimes be really challenging. And we're certainly going to talk about some really specific things today that I think was going to bring a lot of value to our audience in terms of what they can expect in this market, what's going on right now, what could they do proactively to be prepared, what kind of reasonable expectations can they have about what they're going to accomplish in the market, and what the forecast potentially looks like. Obviously, none of us have a crystal ball. But for some of us who have been doing it for quite some time, being in this industry, we usually have a little bit of experience to look back on, and obviously also, especially you being inside specifically the lending industry, is to I'm sure you have your associates who are constantly talking about this, and I know that a lot of lenders really get down to the minutia of the data as to what does this look like, what this might be, but. Just in a general sense, first of all, welcome. And secondly, what is your first gut instinct to somebody asking you what's going on in this market?
That's a good question. I grew up with a father that's an engineer and investing in real estate. His idea was buy, fix up, and keep, rent. And then years down the line, sell that to then reinvest that into more real estate. I remember conversations with my dad when, I want to say I was a young teenager, 12, 13, of him saying, and I remember this clearly. It's one of those things that just, the image pops into your mind. I remember him saying, we're refinancing because we're at 18% and we just got a loan at 12%. And I'm so excited we're going to refinance. And so
talk about context,
right? And when, as my life evolved, I moved to Brazil and had a business there, and then moved back. And my first thing to do was buy a building, what's now called Midtown Miami. It's a mixed-use building. It was apartments upstairs and commercial units downstairs.
And this is with your dad. You're hearing your dad in your
Listening
ear, right?
To my I bought the building from him because he was like, I'm done. I'm unloading this. And I said, no, let me take over. And I ran it for a little while and then ended up buying it from him. And so that was my initial investment into real estate here in Florida after I came back in August of 98.
Okay. So this is 98. Okay.
August
and the interest rate? Do you recall?
I don't recall.
Okay.
I don't recall. So with that background in mind, my thought is always, and I don't know where I picked this up, there's a certain amount of land and a whole lot of people wanting to be on that land. And so whether you buy on an upswing, a downswing, whether you buy by the water, obviously more desirable in some cases, or deeper into the land, people are always going to buy that. There's always going to be demand. And then you add to something you already know, that Florida is one of the spots in the country that for decades, everybody wants to move here, whether it's moving up from Latin America, down from the northern part of the United States, or from the west. Now with this political environment that we're living in, it's somewhat more desirable, or because of tax breaks. There's so many reasons why people want to move into Florida.
Sure. So would you say that your dad was successful in his thinking, even when he was buying property at 18% and then refinancing to 12% and holding on to this property for what? The long term, the long haul?
Yes.
Over that course of the ups and the downs and the dips, which are things that we're trying to share with clients right now, is that what is your time horizon? How long are you going to be holding on to this property? But clearly, and your dad is only one of many, many examples, when you buy real estate and you hold on to it, you win
Yes, you do.
for the long term.
Yes, you do. He bought that building for $35,000. I bought it.
What kind of building was it again?
Mixed use on 36th Street, Northwest 36th Street.
How
near
many
Midtown.
units?
5 units in total. 3 on top, 2 on top, 3 in the bottom.
35,000.
35,000. Sold it to me for 150. I years later sold it for 550. And I can't imagine what it is now today. But as soon as
If you had to guess,
I'm going to look it
if
up.
you had to guess, if you had to guess, because you know the property, you know the area. If you had to guess,
Eddie, upwards of $1 million.
yeah,
Upwards. Yeah. I just don't think you can go wrong. I think you can go wrong according to your plans. And one of the things that I talk to when I have a first client, my initial contact with a client is, what's the plan? I've had clients that are transitional. I call them transitional. Hey, I move around every 2 or 3 years because of work, and I'm here. I sold the property I was in. I'm rolling that into here. I'm going to be here for 2 or 3 years with this company or that company, and then I'm out. Well, that's a different strategy than young couple having or have kids, and we're looking to establish ourselves in this neighborhood until the kids are done with high school, and then we're off on next adventure. That's 10, 15, 18 years commitment. It's a whole different ball of wax. It's a whole different game. But it really is a different plan when you have a long-term plan. For the most part, and I'm hesitant to say this because there's exceptions to everything.
Sure.
But with that in mind, if you look at the people that lost a lot of money in 2008,
mm-hmm.
if they manage to keep that property, they've recouped what they've lost because values have gone up. Now, yes, there's the argument, hey, the last couple of years have been insane, and they have. But it's always an uptick. Property values will go up and down, but always on an upward trend. There's only so much land. I'm back to that. There's only so much land.
So that was 14 years ago when somebody could have gotten screwed, right, by buying at the top of the market back then all hell broke loose. But if they would have sat still for the next 14 years, right, they absolutely would have seen all of those losses erased.
Yes.
And they would have been back on top.
Yes. Yeah.
So
and forgive me.
Yeah, no.
You could even go as far as saying, depending what their interest rate was, at any point in time, they could have refinanced. Forget this insanity that we just saw of 2% interest rates. That's just not feasible. You need a healthy interest rate because that same interest rate that we're paying is what we're getting on our 401ks, is what we're getting on our savings account. So it's a give and take. The Fed, as most everyone knows, is trying to control this whole inflation thing. And people are saying, well, coming down the pipe, there's a recession. And some people say it's going to be a doozy of a recession. And other people say it's not going to be that bad. Whoever's right, there's going to be an adjustment. There has to be. It's ups and downs like an ocean, There has to be a downturn so there can be an upturn. It can't just always be unidirectional, all the way up or always down. It's got to be that balance.
So the people that are waiting for these these exorbitant, quote unquote, exorbitant interest rates we have right now, which are just toppled 7%, correct?
7 and 8, depending on
7 and 8.
Yeah, I always hesitate in giving you interest rates
Sure.
because it's what type of property is it? What's your specific financial outlook? It's so specific to people. It really is, and to the property. I mean, a condominium will be a higher interest rate than a single-family home. So let's just say between 7 and 8.
But to say that they're going to come back down to 2, don't hold your breath.
No.
Buy something now. And a lot of the strategies are buy something now, quote unquote, bite the bullet, and then wait to an opportunity to refinance if that opportunity does make sense for you.
There's 2 reasons that come to mind why I say buy now. And I want to preface that everyone has, or they think they have, a unique situation.
And let me interrupt you for a moment.
Yeah.
I almost start to cringe when we start giving advice about buying real estate right now because they think that you're just trying to sell me something, Eddie. And these are people sitting down at a table that have been doing this for a long time. that are giving good advice based on our experience. Thankfully, our next meal is not going to come from the fact that we're transacting a piece of real estate with you. So if you buy or don't buy, that's perfectly fine. God bless you. But take advice from people who have seen this come and go.
Or better yet, don't take advice, whichever camera I'm looking
Yeah,
at.
exactly.
Don't take advice. Listen to what we're saying. And do your research. There's the YouTube University. There's Google. Just research some of the things we're going to say as to how it applies to you specifically. For example, why do I think you should buy now as opposed to, let's say, renting? Well, there's everyone always says if you're renting, you're paying someone else's mortgage. You are. I have property I rent. You are. You're paying my mortgage. Mm-hmm. You are paying for me to sit on that property so that property accrues value. So thank you. Historically, I'm not an economist, so do your research. Historically speaking, every time we have a recession and people are going, where do I put my money? Money you have liquid that is just sitting there. It's not money you need to survive on. It's not, that cushion. If something goes wrong, you have, 6 months, 3 months, whatever your calculation is of bills. It's money that's just sitting there. It is safer in real estate. Real estate holds its value more necessarily than other investments. Now, I'm not an economist, okay? Do your own research. But based on my experience and based on conversations that I've had with people that are much more intelligent than me, they say real estate is one of the safest places you can put during a recession your nest egg, your money. Compared to stocks, where are you talking about Coca-Cola? Are you talking about this or that, different stocks? Don't know. Not an economist. But definitely real estate is a place for you to put your money. So if you have money set aside, it's your long term, and you're trying to find a safe place to put it, real estate. That's number one. Just letting your money sit there, I think by now everyone's figured out that's the worst thing you could do. So that would be a strong reason. The other thing is, as you rent, if now you're talking to someone that I'm renting and I have a little bit of money and I have my ducks in a row, so to speak, should I wait till next year or the year after when interest rates start going down? I think you should reach out to somebody like me, a professional, that will say, okay, how much are you renting? Let's calculate. This is your rent. This is the projected rent, because as interest rates and mortgages go up, so will the rent. As people cannot afford to buy houses, more demand for rent will be there. Rent will go up. So here's your projected rent. If you were purchasing approximately, what are you looking for? Approximately this property, a single family, a condo, townhouse, villa, this would be your mortgage. And even if that is about the same, you're losing money on the appreciation of the property, where if you're renting, you're paying my mortgage. So there's so many reasons why, if you can, buy. Okay, interest rates. Interest rates are high compared to what we've been used to. Historically, they're not super high historically, but there will be a downturn. So if we're at 7 to 8% now, and they go up to, let's just hypothetically say 8.5%, 9%, and then they start going down, well, then you can refinance and talk to your professional to see if it's worth refinancing within a year, 2 years, 3 years, depending when that goes down.
And that's the part that I really love. And I'm glad you brought it up, is because, it's one of these things where, don't take it from me. Sit down, put a pencil to paper, and sit down with people who maybe are more experienced than you in order to figure this out. But these are calculations. These are calculations that can be made. Absolutely. And those are calculations that can be made over a time horizon.
Absolutely.
You're sitting with that, let's just call it a couple, your typical couple sitting across the table from you. And, you kind of project how long they might stay in that home. What is their potential for greater income? Mm-hmm. Is it just one income? Is it two incomes? All of that. Are you going to have kids? Are you going to have a family? All these things.
And something I love to say to young couples that are starting out is, don't think of your first home as your forever home.
I do the same.
You don't need to buy the 3-bedroom, 2-bath, white picket fence. Buy what you can afford.
Right.
because that money you're going to pay every month is going to accrue in property value, which you can then either keep and rent if that's a route you'd like to do, and use that equity to buy something more appropriate because now you got kids, a dog, cats, birds, or sell it and buy that next step.
Right.
But so many people come to me saying, oh, I want to buy, the palace. And it's okay, but you can't afford the palace. You can afford maybe the garage just to the right of the palace.
But it's the step towards the palace.
But you own it. It's yours. And what you get for it if you sell it down the line will be so much more. That'll be a step to the palace. With that said, something pops into my mind that you need to speak with a professional months before you decide or you think you're going to buy, because there's so much that people like us can guide new buyers.
So let's go there for a moment, and we obviously it can be quite a bit of a conversation in terms of preparing yourself. But what are those first 3, 4, 5 things that come to your mind that you share with buyers that are looking to prepare for? What they come to you and they say, I'm looking to buy something in 6 months. What kind of things should they be organizing and thinking about in order to make a informed and proper purchase for themselves?
Talk to a professional realtor, an agent, preferably someone that, like yourself, this is their bread and butter. They've been doing it for a long time. It's been my experience that agents tend to want to stay within an area. Mm-hmm. So if you're in Stewart, don't look for an agent that lives in Key West. They may be great in the Keys and in the lower Miami-Dade County, not so great in places they don't know. Sure, any agent can go on the NMLS. But the good agents will say, okay, what are your needs? Let me find, and here are 2 or 3 properties, and this is what you're looking for, as opposed to a list of them. Once you have an idea of, okay, what I'm sort of looking at is more or less in this price range, talk to someone like me, the financial aspect of it. I'm going to go through credit. I'm going to go through cash on hand. I'm going to discuss monthly payment and all the different options. Some people think, I don't have a lot of money. Condominium is where I want to go. Not necessarily. You'd be surprised. It takes less cash on hand to get into a single family home or a townhouse or a villa, let's say a non-condominium, than it does to get into a condominium.
What does that mean? Break it down a little bit. What is the difference there?
There's some rules in condo financing that may require a larger down payment, where you're financing 20-25% of the property instead of 3 or 3.5 or 5%. So that's a big chunk.
So I may not be able to use one of those mortgage vehicles that allow me for lower down payment. I might have to have a single family home.
There are, without getting into specifics,
right,
there are many programs. There are mortgage vehicles, as you call them, to help you buy just about any type of property without specific, talking about a specific person situation. Mm-hmm. Generally speaking, a condominium will cost you more money than a single family home of about the same price.
To buy into?
Yes, sir.
Okay.
Yeah. You can buy a single family home for 3%. If you're a first time home buyer with decent credit, decent finances, you can. Condominium.
So I've met with my realtor. I know this is the area I want to be in. I know that for my family and I, we need a 3-bedroom, 2-bath, or whatever it is. We need a yard for the dog. And I know it's going to cost me in this market, depending on where I'm looking, of course, $350 to $450. Okay. What does that look like now? What is it when I come to you and say these are the sampling of the houses that we like, and let's just say an average of 400,000. What do I need to do with you once I communicate that to you?
So when I first meet someone, I'm not really initially concerned with what they're looking for. I'm concerned about the numbers. What do you have in reserves? What do you have cash on hand that you can apply for the purchase?
Okay.
What's your credit look like? What's your employment history look like? All the different things that will make you loanable.
So you shouldn't really be waiting to meet with you to have some of those things already answered in your own mind in terms of
not so much answered, but once we have once a client and I have the conversation and I get their paperwork and I do their financial study, the whole pre-approval, then I can come back to them and say, okay, you can afford, based on our calculations, let's just say $2,500 of principal, interest, taxes, insurance, and if it's a condominium, HOA. And they'll say, well, I'm looking at a house for $350,000, and we'll have that conversation where I'll say, okay, now that we know the number of your finances and what you would like to get, then the three of us can have a conversation whether you should stick with this plan or maybe consider a villa, a townhouse, or maybe a condo is a good choice. I'm not trying to put condos down, but it's not so clear cut.
Well, before we sat down, you were actually telling me about a situation where there's a condo community that's 55 and over,
right?
And they have specific rules as to
income.
As to income, right, and how that's set up. And so not everyone. And it was interesting because you told me it's not really anything that was rocket science, but that the fact that you're known as one of the realtors, or I'm sorry, one of the lenders in there that have lent in the community and know how to craft that mortgage,
how to navigate it,
how to navigate it.
A lot of these, it's a 55 and over community. If you're 55 and over, these are communities that are wonderful to purchase in, depending on what your lifestyle is, what you're looking to do. They're usually less expensive than the comparable non-55 and over community, a 2-2, a 3-2, whatever it happens to be. But this specific community has an income requirement. You must make a certain amount according to what the price is of the purchase. The condo community I live in has a credit score minimum, has an income minimum that they want to see in order to approve you. So, there's some real crazy rules out there for condominiums.
Let's talk crazy.
Okay.
Is the lending landscape, the lending industry, as crazy as it was? And crazy in the sense where I think irresponsible could be a word that's used too, back when we had the 2008 crisis. And I know, and the reason I bring this up too is, yes, it was crazy. Yes, it was wild, wild west. Obviously, in hindsight, you see everything, right? But I also get into a lot of conversations where people equate that time to this time in our market, which of course we already talked about is not necessarily the case. But talk to me about behind the scenes lending programs, lenders specifically, rules that may have changed, things that are tighter, better, more secure, that at least eliminate a lot of the catalyst for what happened back then.
Yeah, it really was wild, wild west. I was not a lender back then, but I was in real estate investment. And you could, Alan Robinson, if you see this, said something that I repeat all the time. If they put a mirror under your nose and you fogged up the mirror, you would get a loan. And it really was very irresponsible. Very high risk. People were buying, I'm sure you remember, they would buy a property, maybe change the color of the walls and flip it and make money within months. It was insane. The government tightened down a lot. A lot of the risky lenders are no longer around. Yes, every once in a while you might come across a story somewhere in the country of someone that was doing not the right thing. I would say I don't know of anyone that has bad lending practices. I just don't. It doesn't happen anymore. Me personally, and all the people that I associate with, would rather tell you, and I do this all the time, hey, let's say, John, listen, yes, I can get you a loan. Interest rate will be ridiculous. However, if you hold out for 30, 60, 90, depending on the situation, and you pay this credit card down, do this, do that, instead of getting this type of mortgage, you can get this type of mortgage, and you'll be in a better situation. I much rather, and I've done it many times, tell someone, let's structure a game plan where X amount of time down the line, you'll be in a better situation, than do a loan that's, and then it comes back to bite me and especially the client.
Again, based on their specific
Yes.
circumstances,
Yeah.
right?
There's
So
just-
you're helping them architect
Absolutely, a game plan.
the game plan.
Yes.
So it may not be today just because they're excited about getting into something today, or their lease is up in 3 months and they're like, oh, okay, I'm ready. It just seems like it coincides with me
Yep.
buying a house and I have a little bit of money and I have a good job. Yes, you may qualify. Yes, you could be handed the keys to that home, but it may not be the best thing in your best interest.
And many lenders will say, hey, I'll put you in loan A and come back to me in a year and we'll refinance you into loan B. And they get the business from loan A and they get the business from loan B. And sure, from a lender perspective, you're creating business for yourself.
Right.
But in my mind, I rather tell that person, instead of doing the A-B scenario, hold out for 3 months, pay down these credit cards, or do this or do that, whatever the situation is, and then we'll put you in loan B right from the start. And it's those people, those situations that appreciate people like me, and they say, hey, Louis took care of me, and here's my neighbor, here's my cousin, here's my aunt, here's my son, here's my daughter that wants a mortgage, and that's how I've created my business.
So let's
that word of mouth.
so that's a great segue. I'd love to talk to you about that. As I mentioned to you before we got on air here, that one of the things I wanted to talk about was more from an entrepreneurial perspective. You know, what are you doing in your business to whether is to me is probably not the right word, because that's just sustaining, but certainly thriving inside of a changing market, right? As opposed to being on the defense. What is it? What can somebody do that's in your position, and what are you specifically maybe doing that you've changed up in order to continue to garner business? Obviously, doing the right thing, which you just described, is always the right thing from a personal perspective. You know, that's something I subscribe to. That when you do the right thing, people tend to scream it from the rooftops, and they say, you know, these are the guys you need to work with, and this is the person you need to work with, and let me explain to you why.
Yeah.
And the minute they realize that you're actually trying to help them out, things change dramatically. And so, you know, for people that are in successful businesses in real estate and finance and things like that depend on a recurring or a constant flow of clients, one of the biggest pools, of course, is your referral pool and people you've served before. Whether you get to serve them again or they refer you to family and friends, that I think for the ones that sustain through times like this are the ones that have built that, right? And then, of course, there's back-end systems to stay in touch and the technology around and all those good things. But what are you doing specifically, or what do you recommend to somebody who's, because this is another thing too, is just like in real estate, in lending, there was people that are getting into the industry 2-3 years ago thinking, oh my goodness, I'm going to make money hand over fist. It's just falling out of the sky. But they didn't build businesses. They didn't build businesses and establish those referral pipelines and ways to sustain things like this. So again, what kind of things are you doing, or what are the things that you would share somebody that's new to the business that they could be doing in order to weather this storm?
I believe no matter what you do, you're in the relationship business. You know, even if you are a network specialist and you live inside a refrigerator with a bunch of computers, you're still at some point in time talking to people, dealing with people. We are in a people business, not real estate, not numbers. It's people.
Mm-hmm.
Creating relationships with my clients, with the people that come to get loans from me, creating relationships with the agents that bring me a client, showing loyalty to the agent. Hey, Eddie, you referred me to Maria, and Maria wasn't ready to get a loan. And I talked to Maria. We developed a plan for a year. Now Maria's back. Hey, Eddie, Maria's back. Not, hey, Maria, why don't you go with so-and-so? No, Maria came to me from Eddie. So that loyalty to the referral partners, people like yourself, the loyalty to the borrower, my client, that I'm going to give them the best advice for them that I know, not necessarily what's going to bring me more money, that creates the, hey, I'm coming back to Louis. I'm coming back to Louis. I had a text from a gentleman yesterday who I did a loan for 4 or 5 years ago. His daughter needed a loan. She came to me. Then his daughter reached out to me and said, hey, I want to refinance. And then he reached out to me, say, I want to refinance. And yesterday he reached out to me and say, hey, I want a HELOC. And it's these relationships that you build. So number one is building relationships. Number two is basics. You know, there's there is fluff in any business. So there are different programs that will address different situations, and knowing those programs would help you. But the bread and butter of your program, the day-to-day, the creating the relationships, the going to the open houses, the knocking on the doors, the talking to people, I think those are the basics you build a business on, and you should always stick with. And then the third part is what we're doing now, embracing new technology and what some of the work we're going to be doing with videos and technology, and understanding that there is that younger segment of people that are saying, Louis, I don't ever need to hear your voice. I don't need to talk to you. I don't need to meet you. Text me, email me what I need. I'll send you what you need. We're good to go. And embracing that.
Well, embracing is the word, because what I've noticed is, in one of your examples is spot on. I mean, this customer, this client of yours that is now referring his daughter to you and family, and moving forward, you're the guy, right? You're the one that they're going to contact moving forward. You're not being interviewed by them anymore, right? They're not asking you questions about your how long you've been doing this, or what is your expertise, or can I trust you questions. None of that is happening anymore, because you've already established that. And so, yes, one of the things, and the reason why I bring that up is because one of the things we're going to be doing together, of course, is marrying that same sentiment with technology, right? And so if you're out there, you're the person that, by way of this podcast and the video and the content that we're creating here as well, we're going to be able to continue to deliver more of that, right? And so that when people see you on camera, and every time they're Googling or on YouTube researching, what are the 5 steps to buying a home, or what do I need to do to buy a home in Boca, your name and your face are going to continue to pop up because you're constantly delivering value. So again, the same things apply when they see you and they get on the phone with you and they say, I saw you on YouTube, which is what happens to me with content. There is no convincing of anything. They're ready to work with you. Yeah. And so that's a really, that know, like, and trust factor, which is something obviously that's used throughout marketing, is incredibly important. And so that's exactly what we're looking to develop together.
Yeah, it's interesting, the connections that we look for. Hey, I need a groomer. Who do I know has a dog? Eddie, Joey, Maria, you have dogs. Do you know a groomer? Do you know a vet? Do you know what this? Do you know what that? That's the old way of doing things. And to this day, I want to say that when I need something, I reach out to my inner circle and see if someone knows or has business with someone they are comfortable with and they refer. What happens next? You and I were just having a conversation about these wooden slats. I don't know if they're on camera, but it's these slats. Exactly. Okay? And I saw them on Instagram. And I said, oh, I know that company. I just saw them. And sure enough, they're on Instagram, and the wooden slats, and they're so cool. And they got this color and that color.
Right.
And so I think we're going from that inner circle, which I want to believe we all still go to okay, but now we have Instagram, and now we have YouTube, and now we have, maybe Facebook or whatever media you're in. And then we go right for the comments. Hey, this one gave it 5 likes. I don't want to read that one. I want to know the one that gave it 1 like or 2 likes or 1 or 2 stars. Why were they unhappy? Are they just grumpy people, or are they legitimately unhappy and I should pass? So, yeah, I see I wouldn't call it a change so much as embracing the technology of doing the same thing. When your inner circle just doesn't know a good groomer, where do you go?
Yeah, it's actually the concept of social proof. Right. Yeah. And so yes, you and your inner circle, when you think about the dog and the groomer, you maybe have 3 or 4 or 5 people that you could think to call, right? Those are your friends or whoever you know. But as the world has gotten larger by way of technology, social media, call it what you want, the ability to reach more people and get a greater collective opinion on something is incredible. So if that's the case, then our ability to reach more people is likely also very possible.
I understand what you're saying. I don't know if it got larger or smaller, because now everyone is in that one little app, and I can reach the company out of, West Boca, 10 blocks from me, wherever, that I didn't know existed, but they popped up because here they are. I don't know. It's interesting. I think it's exciting times to see all
Yes.
the changes that are going on and technology driven.
Yeah, and the clients that we're able to serve, they see it as it's no longer a fad, and obviously you understand that too. It's not something that's going away anytime soon. It's certainly a way we're moving towards, and to be part of that movement in that direction, I think is really important, especially if you're a business owner. If you're somebody that's in the sunset of your career, where you got another 2, 3, 4, 5 years, I'm like, I'll continue doing the way I've been doing it, perfectly fine.
Yeah.
But I think if you've got any aspirations beyond that, I think it's important to figure out where you connect into how we communicate with each other today. Absolutely. So, from a larger perspective, what do you think? Obviously, we don't have a crystal ball, but what do you think is going to be happening in the next 5 years? Again, we talked about the fact that it's very important for everyone to take a very personal, specific view as to their needs, their requirements, and all that. But from a greater perspective, do you think this is something that we're going to be sitting in what would a lot of people consider a negative space in terms of affordability, accessibility to homes in the next? Obviously, I can ask myself the same question. I have my opinions, but I'd love to get yours as to what that you think that looks like in the next 5 to 10 years.
I think there are a lot smarter people that have no clue how to answer that question. I say always to my son and those around me, don't pay attention to what people say, watch what people do. Mm-hmm. You look at the Fed, and they're trying their best to walk this tightrope of control inflation without creating a recession or too deep of a recession. And then you can go down either rabbit hole and listen to all kinds of people that are going to give their opinions. But if you look back historically on the economy and markets, there must be an adjustment. We couldn't go lower than 2% interest rates to zero. You just can't. 2, 3, 4% interest rate is just not long-term sustainable. Now, is 8% the sweet spot? Is 5% the sweet spot? Or are we going to go back to 18% like in my dad's time? I don't know.
Who was still buying real estate?
Who was still buying and financing real estate? So that's the what people say aspect of how I think. Looking at what people do, there's still people moving into the state. People still need homes. I don't see a lot of tents going up in Florida.
Your point earlier about still being Florida, that's not going to stop.
Whether you buy now at 10% interest rate, 7%, 6, 5, 8, 9, if you can afford it and you buy now, at some point in time, you'll be able to refinance that interest rate. And at the very least, you have bought something that is yours that is going to go up in value. So that money's going to come back to you.
That's my biggest hang up right now is just the overreaching sentiment that a lot of these, obviously they're all headlines, right? But the headlines are impactful for a lot of people, right? They get the attention of, and a lot of people buy into these doomsday type of situations, right?
Yeah, I'm sorry to interrupt
No, yeah,
you.
go ahead.
Newspapers and TVs need to sell newspapers and TV news. If they're not dynamic, you're not paying attention. They don't have your attention. So, yes, we're going through transitions. We've been through it before. Unless you're 12 years old, you've been through a transition in the economic market, and we come out of it. So follow your own gut and advice as to what to do. But at the end of the day, property prices will go up. Interest rate at some point in time will stop going up and start coming down, because if it keeps going up forever, then the economy is in trouble.
Right.
If it doesn't adjust back down to some point, whether that some point is 3, 5, 6, whatever that is, then the economy is shot too. So there has to be the give and take.
So let's stay with transitions. Let's pull it away from work and real estate and finance, and what are you hoping to accomplish in 20? This is a question that I'm wanting to ask my guests as they come on board. What are your hopes for 2023 on a personal basis in terms of your business, not your business as it relates specifically, but your own goals in terms of what you're trying to accomplish in the next year?
In my business as a lender, we adjust to the market. You know, right now interest rates are going up. You're seeing product like ARMs, adjustable rate mortgages becoming more popular. You will see transitions of products that, you know, a couple years ago, nobody wanted an ARM. Now people are looking at it. Is that something that is interesting for a specific person? And it is a case-by-case basis. And, you know, there's a lot of arguments about it. But without getting too deep into that, it's a question of adjusting to the market. I enjoy what I do. I love talking to people and feeling that I've helped them in a transition in their life, whether it's buying that retirement home, buying their forever home, or their starter home. I help someone, and that's fun. That feels good. And that's what I enjoy in my work. What comes in 2023, 2024, 2021, that's all mechanics of adjusting to the market and how you better serve the people that you work for.
That you get the opportunity to do.
Yeah, absolutely.
Thanks for joining me, brother. Cheers.
Thank you, sir.